back on Morning Trade Live. Let's focus on Meta Platforms now. The stock is selling off today despite Meta pulling in record revenue in the third quarter. Mark Zuckerberg saying on the earnings call that the company expects to invest, quote, aggressively for computing needs over the next year. Oppenheimer and Benchmark have both downgraded the stock, though, after the call. More on that momentarily. But let's just take a look at the board and take a look at some of these big players in the tech space off the back of what we got from these companies yesterday. And it's a mixed picture. Alphabet is flying today off the back of a solid report card, almost like straight A's for Alphabet there, off the back of a lot of analysts saying that this was well positioned amongst the bunch. Meta Platforms is down 11% in trade today, so we'll dig into that in a second. Microsoft also tracking lower to the tune of 2.4% right now. So Meta is the focus of the morning trade. Joining us now for a closer look is a Schwab Network host, my co-host, Marley Kayden. Look, you and I, Marley, were talking about these numbers yesterday as they broke, and that CapEx number projection is really what seems to be moving the stock lower today. It's interesting. I've just been looking through some of the analyst calls. I'm just wondering, as you take a look at what they've actually said, particularly from Oppenheimer and Benchmark, what is the reason behind why they've actually lowered some of the price targets here?
Yeah, it certainly seems to be a lot of focus on this increased CapEx number, which is going to also increase their expenses. That's concerning. Plus, we've seen, Sam, that anytime there's any miss anywhere, that it's sort of punishing. And this miss is a one-time charge, but it was a massive charge of almost $16 billion. So first, let's walk through the earnings, just a brief overview before we get to the reaction from the street. But, they came in with that one-time charge of nearly $16 billion. That pulled EPS down to $1.05. Expectations were for $6.72. So a massive miss there, despite that being a one-time charge. Revenue did come in, though, at $51.24 billion versus expectations for $49.6. So a really impressive revenue figure. But the Meta saying the implementation of the One Big Beautiful Bill resulted in that one-time tax charge, saying that overall they do expect Trump's laws to result in what they called a significant reduction in U.S. federal cash tax payments for the rest of the year and future years, but a very significant miss there to stomach when those numbers first came out. We were together watching them come across the wire, and it was a considerable miss. Now, this spending spree, though, really seems to be the focus. They've been on a massive spending spree, spending billions of dollars to hire talent, build these data centers necessary to meet AI demand, investing billions and billions of dollars. Now they're saying they're going to invest further in their CapEx estimates just for this year, raising it to $70 to $72 billion, up from a prior outlook of 66 to 72. So moving that range up to the top end. Then their CFO came out and said the expectation is that CapEx dollars in 26 will be even higher than what we're seeing in 25. Because of that, she said, quote, we also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth driven primarily by infrastructure costs, including incremental cloud expenses and depreciation. Also mentioning Susan Lee, that's her CFO, also mentioning the cost of hiring some of this top AI talent and bringing in technical talent in priority areas. So they raised the low end of their total expenses to the year by $2 billion, saying those expenses will come in this year $116 to $118 billion. But knowing they're going to come in higher next year seems to be the sticking point for the analyst community. Oppenheimer, like you said, downgraded them to perform, saying that there's significant investment in super intelligent, despite the unknown revenue opportunity, mirrors their metaverse spending in 2021 and 2022, which we know did not pan out. Oppenheimer also saying investors are going to struggle to rationalize the PE ratio, which is about 29 right now, until there's visibility into 2027, as their aggressive revenue growth is offset by high spending. So they may have had record revenue growth, but they're going to up their spend, and that's going to impact it. Oppenheimer also pointing out that Alphabet right now offers a predictable earnings at a reasonable valuation and is trading at the same PE ratio. So they think right now, if you're looking for an opportunity, that Google is the better play here, at least through 2027. Then with Benchmark, they called it a runaway CapEx story. That's their words. Downgrading to a hold from a buy, removing their price target, saying that there's just too much fresh, comparably capitalized competition in OpenAI, Google, and Tesla, and that the near term they expect shares to be range bound at best, Sam.
Yeah, it certainly is about that spending discipline, isn't it? And I think, that's really the view out there on the street, that margins seem to be a concern here for Meta, where Google, Alphabet, and even Amazon, which we'll hear from later, is a little bit better positioned in that sense. But, I mean, if you do a Control F on the analyst call sheet this morning, you've got price targets lowered across the board. Barclays, Bernstein, BFA, Citi, Jefferies, JPM, Mizuho, Piper Sandler, Stifel, the list just goes on. So, a fascinating reaction to what we've seen from this company. Thank you so much for getting us across that one. Marley, I'll check in with you later. Well, let's trade it now with Joe Tigay, portfolio manager of the Rational Equity Armor Fund. How are you approaching your example trade for Meta this morning, Joe? Good morning.
Good morning, and thanks for having me. I think as a former options market maker, former VIX trader, and current fund manager, I would say I'm approaching Meta as cautiously pessimistic. I think they had a lot of expenditures, some expenses that the street is penalizing them for in this quarter, but I think the future remains bright. Just looking at Google's quarter, who also reported yesterday, the market is in love with. Google is showing that AI, it's definitive proof that AI is instantly accretive. They have shown that people will pay for these functions. They've shown that they can add ad revenue to it. I think the search is not dead for Google. And for Meta, 2026 is going to be such a critical year for them. It's going to be an election year, a midterm election year. They typically do well in election years with their ad revenue. So I think they're going to need to prove that their AI expenditures they're putting out there is going to be profitable. But again, I think they're going to move with the market. The market still has this AI narrative. And by the way, their CapEx expenditures is good for the market. It's good for the AI narrative. It's still proof that people are still putting money into these data centers, these hyperscalers, the semiconductor chips of the world. So I think it's fantastic news for the market. We're going to get through this quarter, and I'm looking at this dip as a potential buying opportunity. Should it go even further lower, love to own Meta. Looking at a downside put spread to get into Meta to the downside. I'm going to use that put spread to actually finance some upside call spreads too. So I'm looking at potentially regaining some of this loss we've had in this earnings call through January. So yeah, I'm just looking at this as a potential buying opportunity. Big dip here. I still like the company for the long term.
Okay, good stuff. Thanks as always, Joe Tigay, joining us there.